while retail investors are zeroing in on the more extensive market, Big Short investor Michael Burry has already warned us of another market slump, this time of even greater extent. In this video, we will see why Burry says that the market has already crashed. Make sure you watch the video till the end. Let's begin. What is Michael Burry known for? Scion asset management pioneer Michael J. Burry, the person who called the 2008 subprime crisis and propelled the book and film The Big Short, is perhaps of the greatest bear on the American economy. He had forecasted another market crash in 2022 and now believes that it's already here. Michael Burry uses Twitter now and again to freely uncover a portion of his positions with respect to the eventual fate of the business sectors. He has previously explained that he frequently erases his tweets and confines admittance to his record to forestall hyped-up conclusions of his posts. Let's look at the main reasons now. 1. High inflation. The U.S. economy is encountering relentlessly elevated degrees of expansion. Expansion, estimated by the Shopper Value List or CPI, is the pace of progress in costs of labor and products over the long haul, and costs have been consistently rising, adding to securities exchange unpredictability. The most recent CPI perusing in April expanded 8.3% on a yearly basis, close to the most significant level the American shopper has found in over 40 years. 2. The Russia-Ukraine War. Russia's attack on Ukraine has added to momentary financial exchange unpredictability in the U.S., what's more, all over the planet. Numerous nations, especially in Europe, have been dependent on Russian energy trades that have been upset by the conflict. Presently, the European Union is pushing toward a settlement on a Russian oil ban. The U.S. gave a restriction on imports of Russian oil, condensed petroleum gas, and coal in March and has since been attempting to increase homegrown assets. 3. Supply chain issues. Production network disturbances are another lamentable reality coming about because of the COVID-19 pandemic. Despite the fact that the U.S. economy has apparently endured the most exceedingly awful of the pandemic, it is as yet managing leftover worldwide production network difficulties. For instance, in Apple Incorporated's fiscal second quarter profit approach on April 28th, CEO Tim Cook cautioned that store network disturbances, exacerbated by China's most recent COVID-19 lockdowns, could slice $4 billion to $8 billion from income in the ongoing quarter. As interest for labor and products keeps on developing, creation should get up to speed. If not, organizations' capacity to fulfill client needs will be limited, harming benefits. 4. Weak earnings. Organizations are confronting headwinds from different points. Value expansion is coming down on corporate profit, and as the Federal Reserve adopts a more hawkish strategy to its money-related approach, this thus comes down on dangerous resources like stocks. While a larger part of market areas experienced development in 2022's most memorable quarter, a few organizations are confronting more vulnerable net revenues. The buyer optional and financials areas are revealing year-over-year decreases in profit, as per a May 20 FactSet analysis. 5. China's economic drag. China's zero COVID-19 strategy is brutally affecting the country's monetary viewpoint. In any case, China's re-established pandemic emergency is likewise difficult worldwide stock chains, which brings about greater costs and deficiencies of certain products with a more extensive reach. Since China has the world's second biggest economy, its inconveniences raise worries about the prosperity of the worldwide economy. Worldwide organizations like Apple, Tesla Inc., and Toyota Motor Corp, which have fabricating activities in China, are seeing critical headwinds for creation, deals, and benefits. Despite the fact that economies are not the securities exchange as well as the other way around, when economies contract, business action typically diminishes and uncovered the securities exchange to misfortunes. 6. Inconsistent labor costs. Some uplifting news is that the unemployment rate stayed at 3.6% in April, the most reduced rate since February 2020. In any case, the low joblessness rate implies the work market is more serious, which has driven a few organizations to one or the other settle up for their labor force or scale back on work. This time, Michael Burry predicts what is happening will be more regrettable than any crisis previously. The financial backer accepts that the conversion of harming factors for the economy has arrived at a higher top in 2021 than some other emergency since the website bubble. As per Burry, 2022 ought to be a plane crash for the economy. This is the end of the video. Hit like and comment your views below. Thanks and goodbye.